Financial reporting is the practice of communicating information. To understand this information, we need to understand the context in which this process takes place. This is why the conceptual framework is important. The conceptual framework, published by the International Accounting Standards Board, is a reference point and a structure for financial reporting. It captures the principles agreed on explicitly and implicitly by all parties, preparers and users of financial information. There are three parts to the conceptual framework that I will introduce here. 1. The objective of financial reporting. 2. What are the characteristics of high quality information? And 3. The elements of financial reporting, the categories that we use to formalize our account of business performance. Firstly, the conceptual framework sets out exactly what information is being communicated and for what purpose. The overriding objective of financial reporting is to communicate information about the financial position and financial performance of a business to users of that information. Who are the users of general purpose financial reporting? They are those of us who want this information and who cannot get the information any other way. In practice, this means actual and potential shareholders and lenders. You may hold shares in a company and you need to know if the company is performing to your expectations. Your decision is whether to continue to hold your shares or to sell all or part of your shareholding. Or you may be thinking of making a new investment, either by buying shares, an equity-based investment, or buying bonds, a debt-based investment. So that's why we define users of general purpose financial reporting as actual and potential shareholders and lenders. In this context, we don't consider all the different individual stakeholders who are capable of getting the exact information they want, when they want, in the form they want, such as a tax authority or the company's bank. We focus on general purpose financial reporting because that's where standardization of information quality is most valuable. So our starting point, our objective, is to provide high quality information about the financial position and financial performance of a business to actual and potential shareholders and lenders. Secondly, the conceptual framework tries to define what high quality information is, or what makes information useful. These are the characteristics of useful information, known as qualitative characteristics in the language of financial reporting. I think of these characteristics as cats. Primarily, useful information is relevant and faithfully represents the economic phenomena that it purports to represent. The words and the numbers on the screen or the page should communicate a realistic picture of the underlying economic reality. So in my model, we have two cats, relevance and faithful representation, and they are the primary qualitative characteristics of useful financial information. Now, by relevance, we mean that information has predictive or confirmatory value. It can help users to predict future outcomes, for example, forecasting future profits, or it can confirm or refute previous predictions. And by faithful representation, we mean a depiction which is complete, neutral, and free from error. Completeness means that all the information that a user needs to understand the economic phenomena is included. Neutrality means that the representation is unbiased, it's neither overly pessimistic nor overly optimistic. And freedom from error means that there are no errors in the depiction which would make a difference to the economic decision. In real life, information does not have to be completely accurate, but it has to be good enough for our decision-making purposes. So two primary qualitative characteristics, two cats, relevance and faithful representation. Then there are four secondary characteristics, known as enhancing qualitative characteristics, which also contribute to high quality information. And I think of these as kittens. Those enhancing qualitative characteristics are as follows. Good quality information allows users to compare the financial results of a business over time or with other businesses, alternative investments. Information is verifiable if independent observers are able to agree that the information provided is a faithful representation of the underlying economic phenomena. Information should be understandable to users with a reasonable level of knowledge, and it should also be timely. These secondary characteristics are kittens because they're enhancing rather than overriding. So if there's a conflict between the primary characteristics and the secondary characteristics, then the primary characteristic prevails. For example, you cannot justify oversimplifying information to the extent that it's no longer a faithful representation just to make it more understandable, because faithful representation is a primary characteristic and understandability is a secondary characteristic. If the underlying economic phenomenon is complex and difficult to understand, then its representation will also be complex. Now, one final point about quality. In any business decision, there is an overriding cost-quality trade-off, and this is formalized in the conceptual framework as the cost constraint. The costs of reporting better quality financial information need to be justified by the extra benefits of that better quality financial information. So there is a balance to be struck between maximizing the qualitative characteristics of financial information and producing high quality financial information at an acceptable cost. And I think of the cost constraint as a big angry dog because, well, how else do you keep cats and kittens in line? So we first identified our overall objective to provide high quality information about the financial position and financial performance of a business to actual and potential shareholders and lenders. And secondly, we defined what we mean by high quality information in terms of what are the characteristics of good information. Now, thirdly, the conceptual framework identifies the elements of financial statements. The elements of financial statements being the type of phenomena that can be represented when we want to tell the story of the business's performance. In order to be included in financial statements, information must meet the defining characteristics of one of these elements: assets, liabilities, equity, income, and expenses. And we must all agree on what makes something, for example, an asset, so that we share a common understanding of the terminology used in financial statements. Let's start with assets because that's where we find the value in our business. Assets are resources, things of value controlled by the business in such a way that they can be used to generate profits. More formally, in the conceptual framework, an asset is defined as a present economic resource controlled by the entity. An economic resource is defined as a right that has the potential to produce economic benefits. What these formal definitions show us is that assets, which we might describe informally as things of value, are really rights, and rights are valuable. They allow us to make money. The right to occupy a building, the right to use a machine which we've bought or rented, the right to exploit a trademark, and the right to stop anyone else using it. The business benefits from its rights to use these resources to generate profits for shareholders. Because those resources have cost money, we need to think about where that money's come from. Well, from the company's owners, its shareholders, and from external lenders, usually bondholders or banks, but really anyone who's prepared to invest money in the company in one way or another in the hope of generating a return. Sources of finance are described as equity if we're talking about shareholders of the business investing their own money, and liabilities if we're talking about external lenders, money that the business has an unavoidable obligation to repay. So we can think about energy flowing around the business. Sources of finance, described as equity and liabilities, that finance being used to create assets, which resources, which the business will use to make profits, which they will then return to the sources of finance, shareholders and lenders. The distinction between equity and liabilities is important. Equity represents the owner's investment and any profits which have been accumulated. Liabilities are obligations, any obligations to outsiders. They might be obviously money-based, the obligation to repay a bank loan or make an interest payment on a bond, for example, but liabilities also describe our other obligations, such as an agreement to supply goods or services to a customer. We also need to be able to capture how the business's financial position changes from one moment in time to another, how assets, liabilities, and equity change. Income and expenses are a way of capturing those changes. Income means increases in assets or decreases in liabilities, so improvements in financial position. And expenses are decreases in assets or increases in liabilities, so deteriorations in financial position. Our financial statements will show the financial position of a business at a point in time, a snapshot of its assets and liabilities and equity, and will also show the financial performance of a business over a period of time, its income and its expenses, or how its assets and liabilities and equity have changed, the extent to which the financial position has improved or deteriorated. And that is a very brief summary of the conceptual framework.